Kai, rookie investor. Maya, senior investor. Nadia, financial journalist. Marcus, retired banker. Did you know your fund returned 25% and you earned less? Maya opens. Not because you picked the wrong fund, not because the market failed you, because of what happened after you made the right decision. This is the behavior gap and has been measured every year for 15 consecutive years, and it was built. He spent 3 months researching before buying his first index fund, Kai admits. He read every document, he compared the ongoing charges figure, he checked the tracking error, he read the fact sheet, all 2 pages of it. He assumed that meant the hard part was over. The fund does the rest from here. He picked it. Now it works. Nobody told him about the fourth thing. The fund performed, Maya states. She did not capture the performance. She picked the right fund and then did the wrong things to it. She checked it when the market fell 8% in March. She also checked it 3 more times that afternoon, in case it had changed its mind. She considered switching when a colleague mentioned a fund that had done better last quarter. She did not switch, but the considering was enough. Series 3 is built around one observation, Maya recalls. Financial behavior matters more than financial knowledge. You can know everything about index funds, compound interest, and asset allocation, and still earn less than the investor who knows very little but acts very little. This is the episode about the fourth thing nobody mentions. The subscribe button costs nothing, Maya mentions. The next episode covers the single investor behavior that creates the most damage, and why it feels completely rational at the moment it happens. DALBAR has measured investor behavior in the United States every year since 1994, Nadia states. Their 2,250 QAIB report covers the full calendar year 2024. The S&P 500 returned 25.02%. The gap, 888 basis points, was the second largest investor performance gap of the past decade. The fund earned 25. You were in the fund. This is not a one-year anomaly, Nadia reads. DALBAR has documented a similar gap for 15 consecutive years. In 2024, investors withdrew money from equity funds in every quarter of the year. The largest outflows came just before a major market rally. The investors who left missed the recovery. The fund recovered, their cash did not. SPIVA's 25-year scorecard. Over the 15-year period ending December 2024, there was not one single equity category in which a majority of active managers outperformed their benchmark. Not one. The professionals underperform the index. The retail investor underperforms further. Selection quality should determine outcome. Kai figures. That was the belief. He spent 3 months on the selection. Then the real investment, the behavioral part, began. And nobody told him that was the part that mattered most. The fund was a constant. He was the variable. Morningstar publishes an annual study called Mind the Gap, Marcus confirms. The 2025 edition covers 10 years of data ending December 2024. The average investor forfeited 15% of their fund's total returns, not 15 percentage points off the return figure, 15% of the return itself. The fund earned 8.2% per year. The average investor earned 7.0% per year. 120 basis points per year, every year for a decade. The source of that shortfall, not fees. The timing and magnitude of investor purchases and sales. Morningstar measured exactly what widened the gap, Marcus states. Funds with the most stable investor cash flows had a gap of 0.8% per year. Funds with the most volatile cash flows, the most active investors, had a gap of 1.8% per year, 1 percentage point wider. Every year, investors in allocation funds, where contributions are automated and rebalancing handled without manual intervention, captured 97% of their fund's returns, against an average of 85% for self-directed equity investors. The difference is automation. 97 versus 85, Nadia states. Automated investors, self-directed investors, same funds, same markets, same decade. The gap between those two numbers is not fund selection. It is whether the investor was allowed to make a decision or whether the decision had already been removed. Back into it. Same 100,000 invested, Nadia states. Fund earning 8.2% annually. Average investor earning 7.0%. Over 10 years, the gap is 23,208. The behavior gap does not feel like 23,000. It feels like checking a portfolio when a news alert arrives. The cost is invisible until the compound picture is seen side by side. The behavior gap is the answer to the thumbnail question, Maya states. It is the gap between what an investment earns over a fixed period and what the investor who owns it actually takes home. Carl Richards named it. Morningstar has measured it annually for over a decade. DALBAR has tracked it since 1994. For 15 consecutive years, the gap has not closed. Through bull markets and bear markets, through the era of financial education apps and algorithmic investing. Someone did earn what the fund earned, Maya confirms. The automated investor, the quarterly reviewer, the investor who made one good decision and then stopped making decisions. The fund is a constant. The only variable is investor behavior. And investor behavior is the primary determinant of whether the gap exists and how wide it becomes. The fund returned 25% and the investor earned less because investor behavior, that is the complete answer to the thumbnail question, Maya states. The timing and magnitude of purchases and sales after the fund was purchased is the primary determinant of investment outcome, not fund selection. Pick the right fund and you will earn what the fund earns. That is the wrong belief, Nadia states. Selection is almost irrelevant compared to behavior after selection. DALBAR tracked the timing of investor decisions across 2024. Withdrawals occurred in every quarter. The largest outflows came just before the rally. Investors systematically buy after markets rise and sell after markets fall. Both decisions move in the opposite direction to what produces returns. The belief persists because selection is visible and measurable. Every fund comparison tool shows you the fund's return. No fund comparison tool shows you what the average investor in that fund actually earned over the same period. The behavior gap is not disclosed at the point of purchase. Morningstar measured the gap by fund volatility, Nadia confirms. For the least volatile funds, the investor return gap was 0.4% per year. For the most volatile funds, the ones that moved most dramatically, the gap was 2.0% per year. The more excitement the fund offered, the less of it the investor captured. Source: DALBAR, Quantitative Analysis of Investor Behavior. 2025 883 basis point gap. 15 consecutive years documented. Source: Morningstar Mind the Gap. 2025, 15% of total returns forfeited. 120 basis points per year. Source of shortfall: investor decisions, not fees. Wealth managers give their highest net worth clients one consistent piece of behavioral advice. Review quarterly. Automate contributions. Do not react to short-term market movements, Marcus states. That advice is backed by Morningstar's 10-year study. It does not appear in the onboarding flow of any mass market investment platform. It does not appear in the product disclosure statement. It does not appear in the push notification that arrives when your portfolio moves by 3%. Online trading platforms generate revenue from per-trade commissions and transaction fees. The more frequently their users trade, the more revenue the platform earns. Morningstar's data shows the more investors trade, the worse their returns become. More trading, more platform revenue, worse investor returns. Every feature of a retail trading app points toward action. Each feature increases the probability of a decision. Each decision widens the gap. The push notification that arrives when your portfolio falls 3% was not designed to inform you. It was designed to trigger a response. That is the architecture. Month, regardless of what the market is doing. The moment the contribution is automated, the most dangerous decision, whether to invest this month, is removed. Step 2. One calendar reminder. Set it quarterly. During the quarterly review, confirm the fund is still tracking the right index. The ongoing charges figure has not changed. The direct debit is still active. That is the full checklist. 4 minutes, then close the platform and do not return for 90 days. What you do not do during the review: check what other funds did, read market commentary, look at the chart since you bought. In the UK, ISA or workplace pension, direct debit set on raise day. In Canada, RRSP or TFSA, standing order before the 1st of every month. In Australia, Super, confirm automated contributions are active. In New Zealand, KiwiSaver confirm the contribution rate is set. Automation is not passive investing. It is the deliberate removal of the decision at the moment the decision is most likely to be wrong. The 1% detail, Nadia states. The quarterly investor outperforms the daily checker. Morningstar confirmed it. Allocation fund investors, automated quarterly review captured 97% of their fund's returns. The daily checker captured 85%. The 12-point gap is not market timing, it is check frequency. The data does not say do not invest, it says do not react. The market rewards patience more reliably than it has ever rewarded timing. He checked his portfolio 14 times today, Kai admits. It was the same number every single time. He is beginning to suspect the number does not update faster because he is watching it. He has decided this is completely fine. He is going to check again tomorrow and the day after that. If this changed how often you are going to check your portfolio, like and share. Someone you know is the daily checker. This is how it reaches them first. Subscribe so you never miss the next one. Next episode, did you know the investment everyone was recommending had already peaked by the time most people bought it? Most investors find out too late. Episode 16 is coming. Subscribe and you will be notified the moment it drops. The episode that surprised the most people on the Money Unlocked channel is linked bottom left.